let's talk markets. Gold's been grabbing all the headlines, right? Smashing records. Everyone look for safety. But, if you're only watching gold, you might be missing something, something much more volatile, maybe even dangerous, unfolding kind of behind the scenes. We're looking at silver, and it's this ecosystem built on what sounds like an impossible promise. We're digging into insights from a real veteran commodity investor, Rick Rule. He basically calls the silver market one of the most dangerously leveraged systems out there today. And get this quote. This is what really sets the stage. We're looking at a market where 200 paper ounces are trading for every single physical ounce available for delivery. Seriously, 200 to 1. That's not just leverage. It's like a time bomb waiting to go off.
It really is. And understanding that structure, that sheer imbalance is absolutely crucial because it dictates everything, especially the volatility. We're pulling this directly from Rule's latest analysis. He's seen, 3 major precious metals bull cycles, and he sees this setup as fundamentally broken. Our job here is to unpack the mechanics of this extreme imbalance and figure out why, in his view, this whole paper setup just can't last forever.
Okay, 200 to 1. That number is just staggering.
Yeah.
If you want more insights like this, the kind that really uncover what's moving markets under the surface, you absolutely need to subscribe to CredEdge. We bring you actionable knowledge fast. So hit subscribe on CredEdge right now. Okay, let's get into this leverage trap.
So Rule puts it pretty plainly. The silver market isn't really driven by, physical supply and demand like you'd think. It's distorted by paper contracts, mostly in the futures market. Think COMEX. And he really emphasizes that ratio.
Cool.
The daily promises made in futures contracts compared to the actual physical silver ready for good delivery. It often hits 200 to 1.
Hold on, let's nail that down. Good delivery silver. What exactly does that mean? Because that sounds pretty important for this whole paper versus physical thing.
Yeah, good question. Good delivery basically means metal that meets the exchange's specific standards. It has to be verifiable, the right weight, the right purity, and importantly, it has to be registered in the vault system the exchange actually uses for settlement. So what Rule's saying is if every single person holding a futures contract suddenly said, okay, I want my metal, for every 1 bar that meets that standard, 200 people would be lining up. That's the gap. Paper claims versus physical reality.
Wow. Okay, so how does the market even function day to day then, if the metal isn't really there in that quantity?
Well, it functions because, until very recently anyway, almost nobody did ask for the metal. The system relies almost entirely on 2 things. Cash settlement and rollover. Basically, contracts get closed out with cash, not silver. Or people just push their contract into the next month, rolling it over. This creates this illusion of liquidity, right? It looks stable, but it's masking this deep structural weakness underneath. It tricks the market into thinking everything's fine.
Right. It works perfectly, as long as nobody actually wants the silver itself.
Yeah.
So what happens when things change? When does this system actually get, tense?
Exactly. It only really gets stressed when there's a compelling reason, usually a price difference somewhere else, that makes taking the physical metal worthwhile. An arbitrage opportunity. Rule pointed to that recent example. I think it was London versus Chicago. The London market, because of local shortages, was paying like 4% more for silver than the Chicago futures price.
Ah, okay. A 4% premium.
Yeah, and that 4% was the magic number. Suddenly, it made pure economic sense for traders. They could demand physical delivery in the U.S. via their futures contract, pay to ship it straight to London, and lock in that 4% profit, basically risk-free. And that sudden demand for physical delivery, for metal to actually move, that caused the held-for-delivery numbers to spike. It put real stress on the COMEX system because they suddenly had to find and move actual metal, maybe metal they didn't have ready in the right place.
And we're seeing signs of that stress trickle down, right? Even in the retail market, you mentioned shortages there.
That's right. I mean, the big bullion banks, they seem to have kept the wholesale bars flowing for the big buyers, the big ETFs and institutions. But for everyday buyers, we've seen these persistent shortages of the smaller stuff, 1-ounce coins, 10-ounce bars. Dealers are finding it hard to keep them in stock, hard to hedge their own inventory. It suggests that the pressure at the physical end, the deliverable end, is definitely real, even if the paper price hasn't fully caught up yet.
Okay, this is where it gets really fascinating and maybe a bit scary for some. What about the idea of a short squeeze? Retail investors trying to break the shorts by demanding metal. Rule has a pretty stark warning about that, doesn't he? What does he think the exchanges will really do if people try to call this massive 200 to 1 bluff?
Oh, he's very clear on this. Unequivocal, really. If things get dicey, if physical demand actually threatens the system's stability, the exchange's #1 priority, #2, #3, It's protecting its members, the big institutions. So this idea of, a Reddit army taking down the bullion banks, Rule basically says, forget it, it's a romantic notion. He expects if the pressure really builds, the exchange will probably just halt trading in silver. They'll set some arbitrary price between the buyers and sellers, kind of a forced compromise. And then mandatory cash settlement, they'll just force everyone to close out their positions for cash, not metal.
It's less like that. Enforced cash settlement. But doesn't the whole point of a COMEX contract rest on the option of physical delivery? Wouldn't doing that just destroy trust in the entire system, even for the members they're trying to save?
That's the million-dollar question, isn't it? And yes, Rule acknowledges it would be catastrophic for confidence long-term, absolutely. But his view is that in an existential crisis, the survival of the institution itself comes first, before the integrity of the contract. However, and this is key, that doesn't mean the price stays put. Rule speculates that the price they'd agree on for that forced cash settlement, in that kind of chaos scenario, it would likely be dramatically higher than where silver is trading now. Just the sheer panic and realization that the paper promises vastly outweigh the physical reality would force a huge sudden price adjustment upwards.
Okay, so chaos, but potentially higher prices forced by the breakdown itself. And we're already seeing warning signs flash globally, right? Rule mentioned specific things.
Yeah, he points to several things happening right now. You've got plunging silver inventories in exchange vaults. You've got lease rates for silver suddenly surging. And maybe most tellingly, specific ETF providers, I think, in India and Europe actually had to stop creating new shares.
Yeah.
Why? Because they literally couldn't source enough physical silver bars to back the new units.
Whoa, hang on. Surging lease rates. Can you quickly break that down?
Yeah.
What are lease rates and why is a surge such a big warning sign?
Good point. Think of lease rates like the interest rate you pay to borrow physical silver, usually from a big bank or vault. When that rate spikes, it means the owners of the silver, the lenders, are demanding a really high premium to let it out of their sight. It's a direct signal of immediate acute scarcity worries in the wholesale market. Lenders are basically saying, we're charging you a lot because we're worried we might not get our metal back easily. It screams physical tightness.
Got it. That makes those warning signs feel much more real. Look, if you're trying to navigate this kind of market volatility using these deep structural insights, you need the best information. Cred delivers that knowledge straight to you. So make sure you subscribe to CredEdge right now. Stay ahead of these warnings. All right, now let's hit the big one. The question that always comes up with silver. Manipulation. Is this market fundamentally rigged?
Rule has a really interesting take here. It's nuanced. He separates the long history from the here and now. He says, look, he doesn't buy into some grand 30 or 40-year conspiracy theory to keep prices down forever. Often just basic market forces, gravity, did that job. But he is absolutely adamant that manipulating the price in the near term, it's, in his words, ludicrously easy.
Ludicrously easy. Why? How?
Because of that massive imbalance again, the huge volume of paper futures compared to the tiny amount of actual deliverable metal. Rule even described how they can do it. Building a short ladder, he called it. It involves borrowing physical metal and then aggressively selling it, dumping it onto the market during the quietest, most illiquid trading hours. That selling pressure, even if it's not a huge physical amount, slams the paper futures price down because the paper market is so much bigger. Then the bank can cover its short position at the lower price they just created. Guaranteed profit.
He thinks the idea that silver isn't manipulated day to day, given that structure, is just extremely naive.
Okay, so if manipulation is easy, and you're basically up against these giant banks playing games, how does a regular investor even stand a chance? It sounds like trying to trade against them is, well, futile. Rule's advice is all about mindset. It's behavioral. He says you have to ignore the short-term noise. Just tune it out. He thinks in terms of years, 4 or 5 years. He looks for the big quantum moves. He literally says the difference between, say, $40 silver and $42 silver is absolutely inconsequential for a real investor. People trying to day trade this, trying to outsmart the bullion bank trading desks, he calls them delusional, says they'll just get chewed up by the volatility and the trading costs.
That's a sharp distinction, the speculator versus the patient investor.
Yeah.
Okay, so that patient, long-term view, given everything, the leverage, the potential end of manipulation, what does it suggest for the actual upside? Where could silver go?
This is where Rule brings in history. He talks about a pattern, a phenomenon he says he's seen in every major precious metals bull market he's experienced. Silver eventually decouples from gold. It stops just tracking it, and then it moves roughly twice as fast as gold, 2 to 1.
Twice as fast. Why? What causes that?
Yeah, well, Rule suggests it might be Classic retail investor psychology. The general public sees gold maybe hitting $3,000, $4,000, but silver's still down at, say, $30 or $40. Mentally, silver just feels cheaper, more accessible. So when the big rally finally grabs everyone's attention, the public piles into silver disproportionately. It's that herd effect, but amplified because the price per ounce is lower. That's what could drive that 2.1 performance ratio.
Okay, so based on that historical pattern, what's the potential number?
Right, so Rule runs a scenario. He finds it perfectly plausible, given central bank buying, de-dollarization trends, all that gold could climb, say, 300% from recent levels during this whole bull cycle. Now, if that happens, and if that historical 2.1 silver to gold performance kicks in again, he says it wouldn't be out of line at all to speculate that the silver price could climb 600%. 600%. And that's not just pulling a number out of thin air. It's based purely on watching that decoupling pattern play out before when these kinds of structural pressures finally break. 600%. That's an explosive forecast rooted in that structural time bomb and historical patterns. Okay, wrapping up, Rule's final message seems pretty clear for you listening. Focus on the fundamentals, right? The real scarcity underneath all the paper, not the daily news headlines. That 200 times leverage, it's not just a statistic, it defines the risk, but also the massive potential reward.
Exactly. And that leads to his final, maybe most provocative point for anyone invested or thinking about investing. He insists, really insists, that true investors need to hold real physical metal, actual bars, actual coins, not just paper promises like ETFs or futures contracts. Because his argument is when that cash settlement system finally bends or breaks, when things get real, price discovery isn't going to happen on a screen based on paper contracts anymore. It's going to shift back to the physical market, driven by pure scarcity, not speculation. So the question Rule leaves you with is, are you holding tangible assets? Or are you holding promises printed on a screen that could just get cash settled away from you when it matters most? Something to really think about. Stay sharp, stay informed, and make sure you're positioned for whatever comes next. If these insights are valuable, make absolutely sure you don't miss our future analyses. Subscribe to CredEdge right now. Get that actionable knowledge you need to cut through all the noise.